Okay. So in yesterday's email, I did send out the clarification about next week. For whatever reason, some people still seem to think that the cap was at 60 for the early final. And now that we have 2 rooms, the cap's been raised. So if you're number 78, which I think was the last number on the list, you should still be able to take the early final, which is May 10th, right? It's a week from today, 10 to 12. There will be a review session that day from 12 to 1, which obviously will not help you if you're taking the early final, unless you really want to come to the review session after the final. And that'll be a good test to see how many of you actually come to that. But the regular final is on May 12th, so I thought the review session should be as close as possible to the regular final. So it'll give you a chance to actually do something before you come to the review session. So I'll kind of keep you posted on those. For the next 3 or 4 days, though, almost everything I will be sending you will be about the project, because the project is due on Monday by 5 o'clock, right? And hopefully numbers are starting to come together for, and sometimes you might just have to start to put the numbers into the report to make sense, because if you leave them as numbers, it can get overwhelming, because you have capital structure numbers, investment policy numbers, dividend policy numbers, and now the valuation numbers. They all come together. But when you do get a chance, please fill out that spreadsheet I also sent you yesterday and send your numbers to me as you get them. So it could be today, it could be tomorrow, it could go all the way till Friday at midnight, Sunday at midnight, but the sooner I get them, the easier my life becomes. And because it's all about me, I want you to kind of cater to my life. So by sending this stuff as quickly as you can. So let's return to where we were on Wednesday. And along the course of today, I'm going to talk a little bit about some of the issues you're going to face in your valuation. And I'll also make a confession. I'm going to cut you some slack on the valuation section, because A, it's at the very end of the semester, so you really haven't done this before. So you might do things that might not be okay if you've been spending an entire semester on valuation. But the spreadsheet I actually have created for this valuation that I've sent to you is actually a spreadsheet that is very forgiving. Forgiving in what sense? It'll do a lot of your stuff for you if you let it do it. In fact, the defaults are set in such a way that you don't get into trouble. So if you want to go change the defaults, do it with the recognition that you need to know what you're doing. So as we go through today, I'll talk about some of the fail-safe things that I've built into the spreadsheet and when you might want to overcome them. So let's go back to what we were talking about with growth. As I said, most valuations, growth either comes from looking at historical data, past, right? Last 5 years, last 10 years, or it comes from asking somebody else, managers, your managing director. In fact, most of you are valuing companies where there is actually a growth number you can go and find on Yahoo Finance or Capital IQ for the future. What's that growth number you're going to be able to find for most of your companies? Most of your companies are followed by equity research analysts. And when analysts estimate growth, it actually becomes part of the public domain. So you can actually go get a growth rate and earnings for your company by going. So yesterday I was checking on Yahoo Finance, and the expected growth for Apple is 9.5% for the next 5 years. That's what analysts are projecting. This seems like a godsend, right? Because in a sense, you're valuing a company, somebody's already estimated the growth, and this somebody is somebody who tracks the company all the time. They should know more about the company than you and I do. So why not just use the 9.5% growth? Let me cut to the chase. If I used a 9.5% growth in Apple in my discounted cash flow valuation, the value per share that I will get for Apple is close to $275. What's the stock trading at? Even after yesterday's earnings report, the stock, I think, dropped a couple of points. It's still trading at 145. This seems like an absurdly cheap bargain, right? What's the problem with using equity research analyst growth rates, even if they're right, in your discounted cash flow valuation? What are we projecting in your DCF? You're projecting out growth in operating income, right? That's what you need, because you want growth in operating income. What's the earnings measure that 9.5% growth is in? What do analysts project growth in? Earnings per share. You're saying, so what? Earnings per share, they're all earnings. A 9.5% growth in earnings per share will not translate into a 9.5% growth in net income, and that will not translate into a 9.5% growth in operating income, which in turn will not translate into a 9.5%. So it's not like every item grows at 9.5%. In fact, you picked the most volatile item in the earnings statement, the earnings per share, to project your growth in. I'm projecting a 1% growth in my revenues, and maybe a 0.5% growth in operating income. And I'm going to argue that that growth rate could actually be consistent with the 9.5% growth rate you see out there. How do I reconcile a 1% growth in revenues with a 9.5% growth in earnings per share? How can the two both be right? Yes. With Apple, the big issue we've talked about is the largest buyback. I mean, it's done, what, $220 billion worth of buybacks over the last 5 years. You're saying, so what? When you buy back shares in the US, they don't go sit in treasury stock. They're actually shares removed from the books. The number of shares outstanding at Apple has dropped by about 12% over the last 5 years. So if you're projecting out earnings per share growth and you're assuming that the buybacks will continue, you can see how a 1% growth in earnings can very quickly become a 6, 7, 8% growth in earnings per share. It's a cautionary note because I see people using that analyst growth rate in DCFs all the time. And the danger of doing that is you're going to end up double counting in a DCF, because if you put that 9.5% growth rate and you discount the cash flows, you're actually counting the buybacks twice, because those cash flows supply the cash for the buybacks and you're reducing the share count through the growth. You're actually double counting. So the bad news is you can't use analyst estimates. You should probably not be just using a historical growth rate. And that's why I said to estimate growth for a company, you've got to understand your company. And hopefully by this stage in the project, you have some sense of what your company does well, what it does badly. You've got to be able to answer two questions. How much does this company reinvest? How well does it reinvest? And we ended the last session by talking about how to measure how much you reinvest and how well you reinvest. If you're talking about equity earnings, especially in the context of a dividend discount model, how much you reinvest is going to be measured by what you don't pay out in dividends, the retention ratio. Sounds fancy, but if your payout ratio is 20%, your retention ratio is 80%. And how well you reinvest is going to be captured by what kind of return on equity you make. So if you have an 80% retention ratio and a 50% return on equity, which are awesome numbers, you'll have an awesome growth rate, a 40% growth rate. If you have a 30% retention ratio and a 12% return on equity, which are blah, blah numbers, blah times blah is still blah, your growth rate is going to be a blah number. I can't endow you with a 50% growth rate if you have a 10% return on equity and you reinvest 30%. It's almost like the laws of mathematics apply. So if we're talking about equity, you're looking at how much do you reinvest out of your net income, how well are you reinvesting with the return on equity. But remember last session we talked about, hey, what if we want to value the entire firm? When I look at the entire firm and I look at how much are you reinvesting, I'm going to look not just at what portion of your net income you put back in the business, but what portion of your after-tax operating income you put back. The EBIT times 1 minus T. And rather than just assume that everything that you don't pay out is reinvested, I have a direct measure of reinvesting because I captured it through the net capex and the change in working capital. So the same numbers I use to get my cash flows, that net capex and working capital, become what I reinvest. If I divide that reinvestment by my after-tax operating income, I come up with something that looks like a retention ratio, but it's actually a measure of how much of your after-tax operating income you're putting back in the business. Remember, you raised a concern of, hey, what if you're reinvesting in cash? With this measure, you're never going to have that problem because I'm actually looking at what you put into projects and working capital, so my reinvestment rate captures how much you reinvest. And here's the big difference between reinvestment rates and retention ratios. What's the highest retention ratio you can have as a company? What's the most of your net income you can retain? 100%. What's the lowest retention ratio you can have? 0%. Retention ratios are bounded between 0 and 100%. What's the highest reinvestment rate you can have? In other words, is your reinvestment rate bounded at 100%? Can you reinvest more than your after-tax operating income? Absolutely. And to do that, what do you have to pull off? You have to either borrow money or raise fresh equity. So if you're willing to raise fresh capital, your reinvestment rate can be 200, 300, 500, 800%. And that's not a bad thing. If you're a high growth company, how do you grow? You raise fresh capital. You go out and take great projects. Your reinvestment rate can be greater than 100%. On the other side of the spectrum, can your reinvestment rate be less than 0%? Yeah. And to do that, what has to happen? Your CapEx has to be less than depreciation, and you might actually be shrinking your working capital. You're saying that's horrible. Is it? If you're in a bad business, what do we say you should be doing? You should be shrinking your business. As you shrink your business, what's happening? You're actually taking your income and returning, and on top of that, you're actually liquidating assets and returning. So if you're J.C. Penney, I want to see a negative reinvestment rate. Why? Because I want to see you shutting down stores and returning more cash to your businesses rather than. So your reinvestment rate is not bound. It can be negative, it can be more than 100%. It gives you the freedom to basically look at companies that are really high growth companies and declining companies, whereas with the retention ratio, you're kind of bound between 0 and 100%. So if you're looking at the entire business, what you reinvest, you capture with the reinvestment rate. And if I ask you, how well are you reinvesting, and I'm looking at this as from the perspective of the entire business, I'm no longer focused on return on equity. I'm looking at what kind of return you make on your overall capital. These are numbers we've used before, right? Return on capital, return on equity. We used them earlier in the class when we talked about what kind of projects do you have. They now come back into service because if you generate a really good return on capital, then you're going to be able to grow a lot faster with the same reinvestment rate. So if you have a 30% return on capital and I have a 10% return on capital, and you put back half your money and I put back half my money, your growth rate is going to be 15%, 50% of 30%, whereas my growth rate is going to be only 5%. There is a payoff to taking great projects. You know where it shows up? You're going to either have a higher growth rate for the same reinvestment rate, or you're going to be able to return more cash for the same growth rate. That's the way I'm going to try to reward you for taking great investments. So let's start simple with this approach to see how it works. I'm going to go back to 2007 in Deutsche Bank. Remember the story I told of Deutsche then was nice, solid bank, stable bank, run by sensible people, paying out what it can afford to win dividends. The good old days, the days of innocence. To estimate the growth in Deutsche, here are the two numbers I estimated. The first, I looked at the return on equity. And based on 2007 net income, their return on equity was 19.5%. They were earning an extremely good return on equity. Remember, this is the year before the crash, and you know that already. We know our history, but you have to act like in 2007, I didn't know what was coming in 2008, 2009, so if I looked at Deutsche, this is impressive, a 19.5% return on equity. Their retention ratio was about 67%, so out of every dollar or euro in earnings, they paid out 33 cents as dividends. They reinvested, the retention ratio was 67%. If I trusted those numbers and acted like those will be the numbers going forward, that from this point on being 2007, they can continue to earn a 19.45% return on equity and have a retention ratio of 67%, their expected growth rate in net income for the foreseeable future, as long as they can maintain these numbers, is going to be a really impressive 13%. The product of those two numbers. But remember, that was just 1 year. And if I had any sense of history, even without knowing the crisis was coming, I'd have looked at 2007 and said, that's a really good year. Do I want to assume that every year from this point on will be a really good year? Or should I do some smoothing out? I think it's sensible to do some smoothing out. In fact, this is a suggestion I'd make for your company as well. If you have a really great year, you don't want to act like every year from now on will be a really great year. What does that mean? Instead of using the 2007 return on equity, I replaced it with the average return on equity between 2003 to 2007. That average return on equity is 11.81%. Not a bad return on equity for a bank, but lower than the 19.45%. Their average retention ratio over those 5 years was closer to 46%. So now I have a competing set of estimates, right? I can use last year's numbers and end up with a 13% growth rate, or I can use these normalized or average numbers, and based on those normalized numbers, the expected growth rate I would give Deutsche going forward is 5.4%. Saying, am I allowed to do this, replace last year's number with an average? Here's the good news, you're allowed to do whatever you want. This isn't accounting. Here's the bad news, you're allowed to do whatever you want. So you're going to wish there were more rules that would say you can't do that, you can't do that, you can't do that. There are no rules here. You can make up stuff as you go along. You don't like last year's return on equity, you don't like the last 5 years' return on equity, you can use the industry average return on equity. It's your story. You're writing the story. You're allowed to develop the entire script as long as you're willing to act on it. So in this case, I used the 5-year average. So in 2007, when I valued Deutsche, that would have been my growth rate going forward based on the normalized values. And with commodity and cyclical companies, I think it's a good idea to look at averages across time rather than focus on the most recent year.
What about for tech companies? Let's say the last 5-year average net income might be low, but that might be because they're investing.
No, but let's back up. When we say tech companies, are we talking Microsoft-type tech companies, or are we talking Snap-like tech companies? So young tech companies. The reason I bring that up is not to pick on him, but I think in the 1980s, if I said tech company, what did you automatically add on as your extra descriptions? High growth, high risk, right? 1980s. In 2015, some of the safest, most reasonably priced companies in the market are old tech companies. You want to get a bargain, go buy Apple, go buy Intel, go buy Microsoft. They're actually cheaper than Coca-Cola and Procter & Gamble. It's the new tech companies where you have this combination of cash burn, where they have negative cash flows, high growth, and high risk. So I'm sorry to step on your line. So let's say you have a young tech company. What about it?
So the problem is they might have invested, in the previous 5 years, they might have invested a lot in building up the infrastructure. Let's say moving to the cloud.
Right.
Their incomes might have been lower because they were still getting customers.
They could be even negative, right? Here's the other thing. These equations work only if you feel your return on equity is stable, which will happen only if your margins are stable, which will also mean that if you're talking about almost any tech company, including a company like Apple, you might say, you know what, this isn't going to work for me because the return on equity is high, but it's going to change over time. I'm going to come back and deal with more general way of thinking about growth where you don't have to make because this is a fairly rigid assumption. It's an assumption that you have a return on capital that you think you can maintain for the next 5 years, which implicitly also means your margins have kind of settled in. This is an approach that worked fine for Coca-Cola 10 years ago, 5 years ago. I'm not sure it works today because even Coca-Cola's margins are unstable. But once you get into steady state, you're going to actually get this equation work because you're saying margins are settled, return on capital is settled, reinvestment rate is settled. This is the growth rate that comes out of it. Now let me make this a little messier. With Deutsche, I used a dividend discount model, right? The nice thing about the dividend discount model is you don't have to estimate anything. The net income is there, the dividends are there. It's almost like a gift on a platter, right? Because you just have to divide one by the other. You got your payout ratio and your retention ratio. But it is lazy. And here's why it's lazy. If I did the dividend payout ratio for Apple and came up with a dividend payout ratio of, let's say, 12 or 15%, which is what I'd get right now, and I said they're reinvesting 80% of their net income back in the business. That's not true because it's really going primarily into cash. That's why we look at what you actually reinvest with your net capex and your change in working capital. Let's borrow that concept and think about how we would adapt it if you're trying to estimate the growth in equity earnings for a company where you know that what they are holding back might not go into the company. So here's what I did for Tata Motors, where I'm going to try to estimate a growth in cash flows to equity. I start with the net income, just like I did for Deutsche. But instead of trusting that whatever they didn't pay out as dividends went into the company, I actually looked at their capex, depreciation, and change in working capital, which tell me what they're actually putting into their operations. So if you take capex, depreciation, working capital, here's a consolidated way of bringing the three together. Capex minus depreciation is net capex. That measures what you put into your long-term assets. Change in working capital is what you invest in short-term assets. The sum of those two is what they actually reinvested back that year. So I'm no longer trusting you by saying everything you don't pay out as dividends is reinvested. I actually look at what you actually reinvest. And because this is an equity cash flow, remember we said that if you're an equity investor and you have to reinvest 100 million, you can raise 20 million from debt, that you have to come up with only 80 million because whatever you get from debt pays for some of the reinvestment. I subtracted out how much of that reinvestment came from debt. So if I take capex minus depreciation plus change in working capital, I get total reinvestment. If I subtract out what I get from debt, I get how much I had to reinvest as an equity investor in the company. Do you see what I'm doing here as opposed to Deutsche? Deutsche, I said, if you don't pay it out as dividends, it's reinvested. Here, I'm actually measuring what you reinvest. And if I take that equity reinvestment and divide by the net income, I come up with something like a retention ratio, but it's actually more directly measuring what you actually reinvest. And over that 5-year period, Tata Motors seems to be reinvesting a lot. 88% of its net income is going back into the business, into what? The Nano, the Jaguar Land Rover, the series of big projects that Tata Motors took on. 88% of their net income went to the business. Is that a good thing or a bad thing? It depends on what kind of return in equity they're making. So let's bring that second half of the equation. But here, I'm going to kind of modify my return equity equation. The standard return equity equation takes net income divided by book equity. Right? That's how we're taught in accounting. Let's try this for Apple. Net income of 50 billion, book equity of, let's say, 200 billion, and divide 50 by 200, or let's make it 300 billion. And you're going to see in a minute why I have to make it 300 billion. 50 by 300, I come up with, not a bad, I come up with like, let's see, 16.67% return equity. But remember, $250 billion of Apple's assets are in cash. That's in the book equity. You could actually argue that if I focused on the non-cash assets at Apple, just focusing on just their smartphone and their tech businesses, they're making 150% return equity on that, because much of that income, almost all of that 50 billion, came from the operating assets. They're making nothing on their cash. So what I compute is I look at the net income and the book equity, but here I focus only on the net income that comes from the operating assets. So subtract out the income from cash, and I look at the book equity net of cash. I come up with what's called a non-cash return on equity. Non-cash in the sense I've taken cash out of the picture. The return equity they earned over that 5-year period was pretty impressive, 43%. So here's what I have again. I have a 5-year average return on reinvestment rate of 88%, a return equity of 43%. To the degree that I trust those numbers, Tata Motors' equity income should grow at about 38% a year if they can maintain those numbers. The 88% I'm willing to live with, because the reinvestment rate. I have absolutely no faith that they're actually earning 43% return equity in the projects. You're saying that's pretty subjective. You know why? What makes me very... If a tech company were earning 43% return equity, I'm probably going to say, well, that's high, but it could happen. An automobile company earning a 43% return equity, red flags should go off. And why the red flags go off? Because there's the industry average I can check against. The average return equity for automobile companies is 8%, 9%. So either this is the most phenomenal automobile company, a niche automobile company. Maybe a Ferrari, I could say, okay, maybe I can see what you earning a high return equity. There's no way a mass market automobile company is going to be earning the 43%. So if you just take the numbers for Tata Motors and you feed them in, you get these extraordinarily high growth rates, but those growth rates are being fed by a return on equity that ultimately is still an accounting number. And the reason I emphasize this is the only place in finance, and I've mentioned this before, return equity and return capital is the only place where we use book values. Have you noticed this? Because when we did levered betas, when we did cost of capital, it's always market value, market value, market value, market value. And then you get to return equity and return on capital. It's the only place where we use book values. Why do you think that is? Why didn't I compute return on equity by taking net income and divided by market value of equity? We've kind of talked about this, but let's make sure we kind of get this out of the way. Why don't I compute return equity based on market value? What am I trying to compute with the return equity or return capital? I'm trying to compute how much you're making on your existing investments, right? I'm assuming that what I see as book value is what you actually invested in those investments. If you're a company like Tesla with a market value of, let's say, right now, $60 billion, if I take your net income and divide by that number, it's really not fair, because most of that 60 billion is for what? Future assets. I'm giving you credit for it because I'm really optimistic about your future. You can't make projects, net income on projects you haven't taken yet. So we stay with book value, and book value can get us into serious trouble. And for some of you, it gives you absurd numbers. This morning I got an email from somebody whose non-cash return equity is minus 168%. You're saying they're taking terrible projects. You know why the return on equity is negative? Because the book equity has gone negative. If your book equity goes negative, your return equity stopped having meaning. It's not meaningful. So don't divide the net income by book equity and keep running with it. If the book equity is negative, just say, I can't compute return equity. You're saying, what do I do next? You have the industry averages, you have the historical numbers. You've got to make do with whatever you can. But to the degree that I trust Tata Motors numbers, you can see why their expected growth will be high if these numbers reflect what they're actually making on their projects. Which brings me back to return equity. So if you think about the fulcrum that drives equity earnings growth, it's having a high return equity, right? There are two ways you can have a high return equity. Actually, three. One is to get your accountants to write down your book equity to make your return equity high, which is the cheating way. Let's take that out of the way. Let's say you're actually talking about return equity on new projects. There are two ways you can end up with a high return equity. The first is to go out and take really great projects, right? But that's so much work, so difficult to do. What's the second way you can pump up your return equity? And anybody who's been in real estate, or even not in real estate, can probably see what that is. How can you take an average project and make your return equity a sky-high number? Leverage. Leverage is your magic ingredient here. And think of why. When you borrow money, what do you pay? You pay the after-tax cost of debt. 4%, 4.5%, 5%, even 6%. That's a really high after-tax cost of debt. And if you can make 9, 10, or 11% on your projects, as the equity investor, when you borrow, what tends to happen? The return equity is going to go up. In fact, mathematically, you can break down the return equity for any company into the return on capital, which is what you make on your actual projects. If you did not have any debt, that would be a return equity, plus the leverage effect. And the way you measure the leverage effect is you look at the debt to equity ratio. You're looking at how much money the company borrows for every given dollar of equity. So the debt to equity ratio is 2. For every dollar of equity, you borrow $2. And here's the benefit of borrowing. It's the difference between the return on capital and what you pay out in your debt. That's what you claim. So think like an equity investor. If your return on capital is 10%, you can borrow money at 4%. For every dollar you borrow, you're getting to keep 6%, right? So as I borrow more money, in most companies, the return on equity will go up. As the return on equity goes up, holding all else constant, what happens to your growth? Your growth will go up. This seems like the best way to increase value, right? Why do we even need this class? Just go out and just take debt, and over time your return equity will go up, your growth will go up, your value. In fact, is that true though, the last leg, that the value of equity will also go up? Let's see why that might not be the case. Let's assume you have a company with a 15% return on capital, an after-tax cost of debt of 5%, and a debt to equity ratio of 100%. That means for every dollar of equity, you take $1 in debt. What's the return equity going to be for this company? If it had no debt, the return equity would have been 15%, right? For every dollar of equity, they borrow $1 in debt. And on that dollar, what do they make? They make a 10% differential, the difference between the 15 and the 5. They've taken their 15% return on capital and made it into a 25% return equity. Does everybody get the 25%? All I'm doing is I'm going back and plugging the 15% of the return on capital. Debt to equity ratio 1, 100%. 15 minus 5. I get a 25% return. This is great. I have a 25% return equity. So let's say I give you two companies, one of which has a 25% return equity because it's borrowed money and pumped up an average project. The other one has a 25% return equity because it goes out and takes great projects and uses no debt. They both have the same return equity, right? And if I plug it into return equity times retention ratio, they will both have the same growth in equity income. Will they have the same value for the equity? Or am I missing something here that is going to come back and make the first company potentially less valuable? What do I get when I project that? I get cash flows to equity, right, with the growth. What do I discount the cash flow to equity at? What discount rate should I be using if it's equity cash flows? Cost of equity. And what's the key ingredient that drives your cost of equity? The beta, the risk-free rate and the risk premium don't change, the beta. And what goes into a beta? What business you're in and how much you've borrowed. Here's how I'm going to punish the first company. They're both in the same business. They'll start with the same unlevered beta, right? But because the first company uses 100% debt to equity ratio of 100%, its beta is going to be higher, its cost of equity is going to be higher. So even though it has the same return on equity and the same growth rate as the second company, its value for equity will be much lower because its cost of equity. This is part of the reason I've kind of made a fetish about adjusting betas for leverage. Because if you don't, this is one of the reasons people borrow money. It's a stupid reason. If I borrow money, my return equity will go up. Yes, that's true. Algebraically, most of the time it works out for you. But your value of equity might not go up because your cost of equity might go up even more than your return equity. And that net effect is what's going to drive, is borrowing good for you? So when you hear people talk about using leverage to push up the return equity, the pushback you should have is, hey, that's true, but your equity just got riskier. Are you accounting for that in your calculation? Because if you don't account for it, you will end up borrowing too much money. So now let's turn to doing this in the context of operating income. So I tried to estimate the growth in operating income for Disney. And to do that, I need a reinvestment rate and I need a return on capital. So basically, everything is now done at the firm level. The reinvestment rate is the net capex. $3,629 million was Disney's net capex. $103 million was their working capital investments. If I add those two numbers up, I come up with $3,732 million as a reinvestment that Disney had in 2013. Their after-tax operating income net of taxes, is $10,032 million is their pre-tax operating income, 31% is their effective tax rate. Their reinvestment rate is 54%. They're reinvesting 54% of their after-tax operating income. And it looks, in percentage terms, it looks like retention ratios and equity reinvestment rates. The only difference is this is a percentage of after-tax operating income. Question?
For the return on capital, just jumping ahead, do we have to include the book value or the value of operating leases as well?
Okay, that's a good question. Actually, let me hold off on that. First, let me set up the definition of return on capital. Then we'll talk about what happens if we capitalize leases. The classic definition of return on capital is after-tax operating income divided by book value of equity plus book value of debt minus cash. In the case of Disney, that number is 12.61%. Now the question was, what if we capitalize leases? When you capitalize leases, first what happens to your debt? Your debt's going to go up, so your denominator is going to be higher. But if you capitalize leases, what do you need to do to your operating income? You have to adjust your operating income by adding back the lease expense and subtracting out the depreciation. You're saying that's such a pain in the neck. You can't just selectively count the leases as debt and not do that. So the answer to your question is you can do it without leases and not do any of the adjustments, or you can do it with leases and adjust both the denominator and the numerator. Usually your return on capital will come down for companies like retail firms, and I think that lease-adjusted return on capital is a truer measure of what you're actually making. So if you have a choice, I'd like you to convert leases. In fact, my spreadsheet does the adjustment for you if you say yes. But that's part of the reason it's called the Ginzu spreadsheet. It's named after when I landed in the US in 1979, I turned on the TV because I was fascinated. I watched a 25-minute Ginzu commercial. I don't know whether you've ever seen this. There's a Japanese chef selling Ginzu knives. So the commercial would start with, do you want a Ginzu knife? So he'll be juggling 3 knives. And I was fascinated. I want a Ginzu knife. 25 minutes later, he would sell you enough Ginzu knife to be a serial killer of a whole town, like 100 Ginzu knives. How about this? A Ginzu knife to cut carrots, a Ginzu knife to... So basically, a Ginzu knife for pretty much everything. So when I started building this spreadsheet, I built it as a valuation spreadsheet and said, wouldn't it be neat if I could just build the leases in? And so I built it in. Then I said, wouldn't it be neat if I could convert? So that's why there are so many worksheets. Think of those as the Ginzu knives thrown into the mix. So if you say yes to that FCFF simple Ginzu spreadsheet, do you want to capitalize leases? And you enter yes and you enter the leases. I'm going to go in and adjust your invested capital for the leases. I'm going to adjust your operating income for the leases. I'll do your laundry for you while I'm there. Compute your return on capital with leases adjusted. So if you want to capitalize leases, I've tried to make it as easy as possible because I know it's mechanically, it's tedious. But because it's the same process every single time, it can be automated. So I would suggest capitalizing leases. And this is actually a lease-adjusted return on capital of 12.61%. So let me pause right there. I have a 54% reinvestment rate at 12.61% return on capital. If I'm willing to assume, and notice with every one of these valuations, I make that point. If I'm willing to assume that they can maintain those two numbers, my expected growth rate for Disney for the next, at least for the foreseeable future, is 6.8%. Notice how I'm not even directly estimating growth. I'm saying, look, that's growth is kind of a made-up number. Instead, I'm going to focus on how much will you reinvest, how well you reinvest, and using those numbers to extract my growth for Disney. So that's my 6.8% growth rate. So when you think about growth, it's easy to take the route of, hey, let's just look at the last 5 years. Let's see how quickly my company has grown. Okay? Or ask somebody else, what's the growth rate for the companies? But if you want to own your valuation, if you want to make this your valuation, you have to put some thought into, hey, what is this company doing to create that growth? Which brings me to the last point about what do you do if you have a company in flux? Because as I said, these approaches of multiplying return on capital by the reinvestment rate, return on equity, and 90% of your companies are in flux. Flux in what sense? Either their margins are increasing because they're young companies and they're building up model, or their margins are decreasing because they're retail companies, the business is imploding on them. You can't use the return on capital times because your numbers are changing. So here's the most general way to do valuation. If your margins are changing, do the common sense thing. Go to the top line. You've got to start by projecting revenues. What are you going to base it on? You're going to base it on how, where in the life cycle your company is, how big the market is. So you're going to start with revenue growth and building it. So already you can see why you can use this now for a young company, because even if you're a pre-revenue company, I can project revenues out based on what your market is, what your product is. That's the first step. The second step in the process is you got to take your company's margins from today to where you think they will be in the future. So let's take your example. Let's suppose your company right now is losing money. It has a negative margin. Let's say 10 years from now, you expect that margin to become 15%. You're saying, what if I expect the margins to be negative? Why are you even valuing the company? If you're that pessimistic, don't value young startups because none of them will be worth money. So let's put the optimist hat on and say, okay, 10 years from now, my margin will be 15%. Here's what I'm going to do. I'm not going to increase your margin to 15% next year because that's not practical. Over time, I'm going to coax your numbers from where they are now, minus 20% to plus 15%. So I've got revenue building up on the top line. I've got my margins changing on the second line. You multiply revenues by margins, you get an operating income. Initially, that's going to be a loss. But as your margins improve, your losses will become profits. It's so easy to do on a spreadsheet. Just be glad you're not doing it in a real business. It's so much more work. But on a spreadsheet, all you have to do is make your losses into profits. And then there's a final loose end I have to tie up. You have all these ambitions about growing revenues, right? You want to make your revenues go from 100 million to 10 billion over 10 years. That's great, but it's not going to happen by itself. What do you have to do to grow? You have to reinvest. That lesson doesn't change, but here I'm going to estimate how much you reinvest by looking at how much your revenues are changing rather than your return on capital, because there's nothing in the return on capital to use. So if your revenues increase by $1 billion, the question I'm asking is how much capital do I have to invest to get $1 billion more in revenues? And a ratio that I use here, which I find incredibly versatile, is a ratio called the sales to capital ratio. It's revenues divided by invested capital. That same invested capital that we use for return on capital now is scaled to revenue. So if that number is 2.5, I'm saying for every dollar that I invest, I get $2.5 in revenues. That's it. If I have those three numbers, I have my cash flows. If I have my cash flows, I should be able to complete the valuation. That's basically what I did for Baidu. I basically gave them revenue growth of 25% a year for the next 5 years, scaling down, because as the revenues get bigger, it gets more and more difficult to maintain the growth rate. My end revenues for them are $154 billion. That's an insanely large number. But what's my justification for it? Come on, you know it by now. China. And I'll move on. See how nice it is to have China as your backup? Hey, they control the Chinese search engine market. That's the fastest growing online market in the world. Yeah, China. For the margins right now are astronomically high. This is actually the opposite of a startup problem. They so dominate the market that they have 49% margins. But here's the problem. You now have Alibaba and Tencent. So it's not even that Google is coming after them. You have other people going after the online advertising market. I'm going to assume that the margins are going to decrease over time. You're saying, no, how do you know? I don't. This is my story. You don't like it? Tell your own story. So my story for Baidu is it's going to be a growing company with margins under pressure. Still great margins. I mean, companies would kill to get a 35% margin. Google's margins right now are 27, 26%. So I'm still giving them much higher margins than a typical US tech company, 35% margins. So here's what happens. As my revenues go, my margins change, I get the operating income. And my operating income is actually going to grow slower than my revenues simply because my margins are decreasing over time. I start with an effective tax rate. Why? Because if you have really good tax lawyers, I'm assuming you're not going to fire them tomorrow, that they're going to find a way to protect your overall income from being taxed. Notice how what I'm doing here is different than when I did cost of debt. What did I say we should always use as the tax rate to compute the after-tax cost of debt? The marginal tax rate. Here I'm kind of wiggling, right? I'm saying use an effective tax rate. How would you reconcile the use of a marginal tax rate to do cost of debt, but an effective tax rate to come up with after-tax income? What's different about the two scenarios? Because there must be a difference. Otherwise, I should be using marginal on both. When I did cost of debt, what's my rationale for using a marginal tax rate? You're Apple, you borrow money. Those interest expenses save you taxes at the margin. You're saying, what does that mean? It's on the last dollars of income. And it's even more than that. It's on the last dollars of income, not on their global income, but on their US income. Why? Because that's where they get the biggest tax benefit. All of Apple's debt is placed in the US, and it's strategic. It allows them to collect a 40% tax benefit on it. Now look at all of Apple's income. Apple's income globally is all over the place. It's taxed at 15% in China and maybe not 40% in the US. It is true that if they bring their money back to the US, they will have to pay the 40%, but it's clear that they're not doing it because they have $220 billion in trapped cash. With Apple, I'm not going to assume the tax rate is going to jump to 40% right away on their overall income because that's not what they're doing. But here's what I do. I do start at the effective tax rate, and I assume that over time, it'll catch up with you. You can't keep cash trapped outside the US forever. Now the question is what it's going to catch up to, and here we're in a particularly uncertain point in time in history. Because 2 years ago I said go to 40%, that's the tax rate in the US, it's not going to change. Now of course you have no idea whether this tax rate is going to, I personally I don't think it's going to go to 15%. Don't make this into some kind of a scandal story or something. I just don't see it because I know how Congress works. I think we'll end up probably around a 25 to 30. So I'm actually using a 30% tax rate for the US in my valuations even before the law changes because I think the 40% is just, it's going to be history sooner rather than later. But when I did this, basically I used the Chinese 25% tax rate as my end game, saying, hey, Baidu's entirely in China. Over time, its tax rate has to drift up towards a marginal tax rate. But it's not going to start right away. So my tax rate changes. That gives me my after-tax operating income. And I look at the change in revenue. So if you look at the revenue, it increases by $7 billion in year one. So basically, this is just the change in revenue year to year. You're saying, why do you need that? Well, I assume that for every dollar that Baidu invests, it gets $2.64 in revenues. And I base that by looking at what their existing revenue to invested capital ratio is and looking at industry averages. So it's not an unreasonable number. So here's what happens. My revenue needs to go up by $7.19 billion in year one, right? If I get $2.64 in revenues for every dollar in capital, all I need to do is take the revenue and divide by 2.64. So the 7,189 divided by 2.64, I come up with my reinvestment in year one of $2.722 billion. What's in the reinvestment? Net capex, change in working capital, acquisitions, it's all in there. You're saying, why aren't you breaking it out? Because I have no idea how Baidu is going to grow. Baidu doesn't have an idea how it's going to grow. Why go looking for trouble? Just take the consolidated number. So all I'm doing is taking the change in revenue each year, dividing by that sales to capital ratio. I get the reinvestment. In the last column, I subtract the reinvestment from the after-tax operating income. I have my free cash flow to the firm. Now, do you see what it's going to look like for a young growth company? So for a young growth company, let's say it's losing money. So I'm going to start with a loss, right? You're probably not paying taxes. The loss will stay the loss. When I look at the reinvestment, What do I base it on? How much your revenues are growing. And your revenue should be growing a lot, so your reinvestment is going to be a big number. You take a loss and you subtract out a big negative number, subtract out a big reinvestment, you're going to end up with a free cash flow in year one, which is a big negative number. So when I do a young growth company, here's the pattern I'm going to see in my cash flows. I'm going to see big negative free cash flows up front, and over time those free cash flows are going to become positive. And what's making them positive? What's going to, for a young growth company, what's going to make those negative cash flows become positive? One is your losses will become profits, right? But there's another force at play as well. As you go through time, what's happening to my growth rate? My growth rate starts to decrease. As my growth rate starts to decrease, my reinvest. This is the good news that comes with slowing growth. When growth companies think about growth slowing, it's a depressing thought. Oh my God, my growth is going to drop. But that's when you start to see cash flows open up. So when you do this for a young growth company, don't be surprised to see negative free cash flows in year one. That's called cash burn. VCs call it cash burn because it's basically you're burning through cash. And the reason VCs worry about it is why? Because when you're burning through cash, what do we just say you have to do? You have to go out and raise fresh equity usually, which means you as a VC will see your position get diluted over time. So you should be thinking about how much cash is this company going to burn through, but it's a feature, not a bug of young growth companies that to grow, you're going to be burning through cash. Uber burned through, $6 billion of cash last year. They're probably going to burn through another $4.5 billion this year. And the way things are going for them, they could have negative free cash flows for 6, 7, 8 years. Doesn't make them a bad company, so don't get this wrong. You could still end up with a $20 billion value company, but it's a company where margins are not improving fast enough for lots of different reasons. Incredibly competitive, ride-sharing seems to be, and the reinvestment is turning out to be more expensive than they thought it was going to be 2 or 3 years ago. So you can take almost any young growth company and feed it through this process. So we've talked about cash flows, we've talked about discount rates, we've talked about growth. Let's talk about the elephant in the room. What I mean by this is when you do a DCF valuation of a company, almost without fail, your biggest number is going to be that number you put to this company in the end, the terminal value. And if you're doing an intrinsic valuation, there is only one way to get a terminal value, and you're not going to like it. You have to get to a point in time and tell me that beyond that point in time, your cash flows will grow at a constant rate forever. Right? What that buys you is, of course, a perpetual growth model, which means to get my value in year 10, I get my cash flow in year 11, that becomes my numerator, and divide by the difference in the cost of capital and the growth rate. We've already used this, right? We used this for the Disney theme park. We're now expanding it to an entire company. This is the most dangerous number in valuation because when analysts are in trouble, this is where they go to make their company more or less valuable. So I'm going to draw some restrictions on that number because if I don't constrain you on that number, you can make any company worth any number. Right? So the first thing that you will have to face with your company is, remember, to do this, you have to assume your company will grow at a rate less than or equal to the economy. Right? Because to maintain a growth rate forever, it can't be 6, it can't be 8, it can't be 10, it definitely can't be 23% a year. It can be maybe 2, 1.5%. In fact, I use a very simple cap on my growth rate. It has to be less than my risk-free rate. So if your growth rate is higher than my risk-free rate, which right now in US dollars is 2.5%, I can't put you in stable growth yet. So the first thing you have to ask is, when will my company become a mature company? Now let's look at some of the things that are going to go into this decision. The first is you're going to look at how big your company is relative to the market that it serves. So if you're valuing Toyota, it's a big company in a mature market. It's going to be very difficult for Toyota to grow 10% a year for the next 10 years. So the first thing you're going to look at is the size of the company relative to the market. The reason I say relative to the market is Google is a big company, right, in the online advertising market. So why am I not putting it into stable growth right away? Because the online advertising market itself is growing. So if you're a big company in a growing market, you get a degree of freedom that you would not have got if you're a big company in a mature market. The second question I'm going to ask you is, how quickly are you growing right now? Before I give you a growth period of 10 years, if you've been growing at 2% a year for the last 10 years, why am I wasting my time giving you a high growth period of 10 years? So I'm going to look at your historical growth in revenues, not in net income, because your revenues tell the tale sooner than everything else in your income statement. And the third question I'm going to ask you is going to sound like a tangential question. I'm going to ask you, what kind of competitive advantages do you have as a company? What are your barriers to entry? Why do I ask that question? What's the value of growth? It's not just the growth rate, it's what kind of return on capital you invested in to get that growth, right? And let me explain what I mean by that. Let's say you grow 30% a year. You're saying that's good. But let's say the way you grow 30% a year is by taking projects that earn a return on capital that's equal to your cost of capital. What's the value of your growth? That's zero, because that's like taking zero net present value investments over and over again. You can take 100,000 of these investments, and I don't care. So if I'm going to spend time finessing your growth rate, I first want to make sure that you're the kind of company that deserves that attention. Now do you see why I asked you what your barriers to entry are? If you are going to earn more than your cost of capital, in any competitive marketplace, people are going to try to come in and take away your profits. You got to tell me, on Warren Buffett's words, the moats you've created around your business to keep those people from coming in. So let me throw a few companies at you, and you tell me what their competitive advantage is. What's Apple's competitive advantage? Perhaps the technology, the operating system. Let's face it, that is a big chunk of their, because you can't exactly produce a smartphone, call it, and use the Apple operating system. It could be the styling. But that's, what's Amgen's competitive advantage? What keeps people from coming in and eating away their profits? They have patents. What's Tesla's so as you go through companies, you can see that with companies where you feel comfortable putting growth, there has to be something you hang your hat on. But what if I gave you this company that people say has incredible potential? I still remember when Groupon went public, and I was trying to figure out. I mean, remember, when it went public, people thought it was a star company, right? It was growing, and it had this charismatic CEO had visions of grandeur. And the one thing that I could not get over is I kept asking, what is Groupon's competitive advantage? And the only thing I could think of is they got my email address sooner than everybody else. And after they went public, guess what starts happening? Amazon's deal of the day, living so basically you could see the proliferation. There was no way they could keep the competition out. That's the kind of company where you can have high growth, but you got to be skeptical about that growth creating value. So ask those three questions. How big is my company relative to the market that it serves? What's its past growth rate been? Take a look at it, because if your growth rate is going to go from 2 to 15%, tell me what's changed. And if you can give me a good story as to what's changed, I'm okay with it. And the third question I'm going to ask is, what kind of competitive advantages do you have?
This is going back a bit, but how do you square the infinite life assumption with the life cycle of the firm?
Okay, that's a really good question. When the question was, how do you square the infinite life assumption with the fact that in life cycles, in any of the class, here's what a life cycle looks like, right? It grows and you peak, and then what happens? You decline and go. Can I use this model for a company like that? What do I need to do with my growth rate forever then? Can my growth rate forever be a negative number? Absolutely. People don't use it often enough. In other words, I can make my growth rate forever minus 5%. You're saying, what's that going to do? Think about mathematically what's going to happen. My operating income is going to peak in year 10, and basically it's going to drop over time. It's going to, it's never quite going to disappear. So we need to exploit that fact more rather than do this automated, put in a 2% growth rate forever. Because in the DCF world, every company becomes a GE. Have you noticed this? Every company grows at 2% a year forever. How do all these mammoths coexist in an economy? So I think we need to have more flexibility when it thinks about growth rates. So if I'm doing let's say an oil company, I said, we can't grow forever. I'm going to put in a minus 3% growth. So if I open that door and allow myself to put a negative growth rate, I can take care of companies. But here's the other point, which is even when I put a 2% growth rate, The growth itself doesn't create value. It's what I assume about returns on capital. So I'm going to come back and make that point and argue that maybe this terminal value thing is not as big as it looks. It looks big, but really the value is still being created in years 1 through 10, and if without that value, the company is not going to be worth much. Okay? So I decided to take a look at my companies to see when I should put them in stable growth. So let's start with Disney. Remember I came up with a 6.8% growth in 2013? I said it can keep growing. For how long? I looked at the fact that if you looked at its past growth rate, it was growing at about 7 to 8% in the years leading into my valuation. But here was the tipping point for me. It was earning well above the cost of capital, 12.6%, and I could tell you why. I could give you a story about why Disney earns more than its cost of capital. Incredible brand name, especially in its movie franchises, the Pixar franchise, the Disney animated movie franchise, the Star Wars franchise. And at least in 2013, I had to pull my ace out of my back pocket, and that would have been, hey, we've got a cash cow within Disney that's going to keep us going, which would have been ESPN. Now do you see why, if I were valuing Disney today, the story is probably going to be a darker story? I mean, we've been reading the news stories about ESPN layoffs, but the broader story is ESPN for the last couple of years has really been under assault as people cut their cables. And ESPN, for better or worse, has tied itself to the cable business. It's very difficult for them to step away because they make billions of dollars from their cable connection. HBO has had to very tentatively, HBO Go, for instance, it's very tentative. They can't really cut their cable connections without pissing off cable. And that, I think, is, so if I value Disney today, the story might be a darker story. It doesn't mean I'm going to give them no growth or negative excess returns. But in 2013, my basis for what they had allowed me to give them a 10-year growth period. Sounds high, but with a fairly low growth rate, a 6.8. So I'm not giving them 10 years of 50% growth because they're a big company. I'm giving them 10 years of 6.8% growth scaling down. Then I took a look at Vale. Vale is a global commodity company. It's an iron ore company. It is the largest iron ore manufacturer in the world. It actually has a market share of like 43% of the iron ore business. The iron ore business is a mature business. There was that period of 10-year growth as China built up the infrastructure, but that's behind us now. So with Vale, I said, there is no high growth period. I'm going to value them as a mature company right away. With Tata Motors, I gave them a growth period, but grudgingly. Grudgingly, why? Because in India, they're running in place. They're not getting the growth that other companies are getting because there's incredible competition, and they're not quite keeping up. You think, so why are you giving them a 5-year growth period? Well, they got lucky in 2009, and when they bought Jaguar Land Rover, and Jaguar Land Rover is now entering into emerging markets, especially and growing faster. So at least in November of 2013, I gave them a 5-year growth period. And finally, I looked at Baidu, young tech company in a huge growing market. It's like you get a double whammy. It's got a big market share of that market, but because the market itself is growing, I gave them a 10-year growth period. Notice 10, 5, 0, 10. You're saying, why 0, 5, 10? Why not? Why not 4? Why not 7? Why not 11? Eh? If you want to change it and tweak the numbers, to me, it doesn't make that much of a difference if I use 6 as opposed to 5, 4 as opposed. So in a sense, don't waste too much time. Will it be in 3 years or 5 years? Kind of make a decision. Is this a long growth company, a short growth company, or no growth company? I've never done a valuation with a growth period longer than 10 years. And I always get pushed back on this. So when I valued Snap, the question I got asked was, why do you stop after 10 years? They could grow for 25 years. So let's take the second part of the question. Are there companies that have grown for longer than 10 years? Yes, absolutely. We can name them, right? They're the legendary companies. You've got the IBMs in the last century, but it's IBM, it's Walmart, it's Microsoft, it's Google. What does the fact that we can name these companies tell you about these companies? They are the exception, not the rule. And here's my first rule in valuation. I don't want to value my company to be the exception. You know why I don't want to do that? If I value my company saying this is going to be an exceptional company, I come up with a value and I buy the stock based on that valuation. What am I exposing myself to? All this company has to be is less than exceptional. That's like looking, I'm a Yankee fan. I look at Aaron Judge and I say, Mickey Mantle. I might be getting a little ahead of myself. It's 25 games into his rookie season. He's hitting really well, but he's not Mickey Mantle yet. But if I build in my head, that's Mickey Mantle, that's 5 World Series in the next 10 years, I am setting myself up for disappointment, because if he turns out to be really, really good, but not Mickey Mantle, and the Yankees win only 2 World Series in the next 10 years, I'm going to be incredibly upset. When you do valuation, the reason I stop at 10 years is that's the 90th percentile of growth periods for high growth companies. If I take the history of high growth companies, 90% of companies, their growth period is, so that's you know what the median growth period for a growth company is in the US? It's 3 to 5 years. Kind of a depressing thought. 3 to 5 years, and then everything kind of blows up on you. So 10 years is already high, so I stop at 10. So let me do my Vale valuation. This is a valuation that I did in November of 2013. Remember, I told you I'm going to use a stable growth model. But here's the problem. It's a commodity company, right? You're saying, so what? With a commodity company, and if I use a stable growth model, and I use last year's numbers to do the valuation, I'm asking for trouble. And here's why. Even though it's a stable company, its earnings are going to go up when iron ore prices go up. They're going to go down when iron ore prices go down. And if I just take the most recent year and plug it into my valuation, if iron ore prices are high, I'm going to come up with a high value. If they're low, I'm going to come up with a low value. And I don't want to kind of go up and down with the commodity price. So if I don't want to do that, what's the logical fix to that? What should I do? I just looked at the average across 5 years. This is just common sense, right? And basically, look at the return on capital. So basically what I did was I took the 5 years of data, and rather than use the most recent year's numbers, I looked at the average operating income, the average return on capital, the average tax rate across a 5-year time period. So my operating income, which was $15,487 million from the most recent 12 months, I'm going to replace with the normalized, the average number across the 5 years. The cost of equity and capital, I followed the standard practice. In fact, those come from an earlier slide that you saw on cost of equity and capital for Vale. I built up a bottom-up beta, so did all the stuff. The cost of capital I ended up with, in US dollar terms for Vale, was 8.2%. I'm almost there. I have my normalized income. I have my cost of capital. I use that normalized income to compute their return on capital, and their return on capital based on the normalized income is 17.25%. So I have the most recent year's income, I have a cost of capital, I have a return on capital. I put in a growth rate of 2% a year forever. Why 2% a year forever? Well, in a sense, the risk-free rate was, basically I've let the growth be inflation rate plus a little real growth, 2% a year forever. Now, to grow 2% a year forever with a 17.25% return on capital, I've got to put money back. Just because it's a mature company doesn't mean I can take all the earnings out. So each year they're going to have to reinvest 11.59%. So let's pull the numbers up. The 17,626 is the average income over the previous 5 years. The 11.59% is the reinvestment rate. The 20.92% is the weighted average tax rate globally. There's my free cash flow to the firm. I divide by cost of capital, 8.2% minus the growth rate. The value that I get for Vale's operating assets with normalized values as a mature company is $202 billion. I add cash, and I subtract our debt. They have a lot of debt, $42 billion. I get a value for the equity of $167. Divide by the number of shares, you get a value of $32. Stock was trading at 13. Now, why do we do valuation again? I kind of threw this out last session. Because we want to act on those valuations, right? So ask me the question. You know the question I'm talking about, the one that will tell you whether I actually have faith in my own valuation. Did I buy, right? And I did. And God, did I feel a lot of pain. Because the stock dropped as low as $3. I revisited the valuation. The reason it dropped was, I could tell you it's not my fault. And it's really, part of it is not my fault. Because here are the things that happened since 2013. The iron ore prices kept dropping. I didn't see that coming. Brazil went from being a near developed market to, at least internally thinking, it was back to being 1992, right? The country imploded. So you have country risk, commodity risk, and currency risk all kind of coming together. I couldn't have seen that, so that part I'm willing to say was not my fault. But this is what I missed. I assumed that Vale's operating income that they were reporting already reflected the drop in iron ore. Because iron ore prices had already dropped, I assumed that the income reflected the lower iron ore prices. What I've discovered in hindsight is in the commodity business there seems to be about a 2 to 3 year lag between prices dropping for the commodity and earnings actually showing the number. It's not because they're lying or cheating. It's because they often have forward contracts, so it takes a while to roll through. There is a happier ending to this story, because I did sell Vale at 5. In fact, I titled the blog post, I had no mas, no mas. And then I got all these emails from Portuguese readers saying that's not the right. I said, I wasn't even talking Portuguese, right? I don't even speak Spanish. So no mas is my carryover from 30 years ago from one of the most famous boxing fights of all time. This guy called Roberto Duran was fighting Sugar Ray Red, and 2 rounds in he said no mas. But I got all kinds of blowback for getting the language wrong. I did sell it at 5 because my value had actually dropped to 4 with the numbers updated. You said, how can the value go from 32 to 4? Hey, the world changes around you. You can either hold on to the 32, I did it once and I'm not going to change it ever, or you adjust to it. So I sold. But the good news was I bought back when the stock went to about 2. I actually ended up making, overall I've made money back on Vale. I've covered these losses, but it's pure luck, I'm sure. I mean, I just managed to hit it at the right time. But that's, when you talk about mature companies, especially with commodity companies, you might have to do some cleaning up. So let's revisit the Disney numbers. So for the next 5 years, I'm going to give them 6.8% growth, then I'm going to bring the growth down. Then in year 10, I'm going to make them a mature company, actually year 11. There are 4 rules I'm going to suggest you follow when it comes to terminal value. First is, respect the cap. You say, what the heck does that mean? Remember I said when I talk about growth forever that I use my risk-free rate as my cap? The reason being, I know it's human nature. If I'm optimistic about a company, I want to push up the value. That if I don't restrain myself, I'm very quickly going to play with this growth rate and keep pushing up the growth rate forever until I get a high value. So I'm going to keep the growth rate at the risk-free rate. Incidentally, one of the defaults I built into your spreadsheet, that FCFF Simple Gunzer spreadsheet, is your growth rate grows to the risk-free rate. And then I ask you, do you want to change that? And if you say yes and enter a different growth rate, I say, okay, you know what you're doing, even if you don't, and I'll do the valuation. And incidentally, if you want to make the growth rate negative, which we talked about, you can do that as well. You can say yes, replace the growth rate with the growth rate forever. Second, think about what your company's returns on capital are going to be, not right now, I know what they are now, but beyond year 10. You see, what does that mean? The cost of capital for Disney after year 10 is 7.29%. So basically, I recompute the cost of capital. The question I'm asking is, I've gotten to year 10. I'm now looking at year 11. Do I think Disney can continue to earn more than its cost of capital essentially in perpetuity? And my answer was yes, because I think Disney's assets are in a sense timeless. They're going to be impossible to replicate, partly because they reflect the history of Disney as a company. Most companies, when you get to this point, say, will you earn more than the cost of capital? I'm going to say, no, after year 10, that's not going to happen. Your Tesla, I think you're a great company, but eventually your return on capital is going to come to your cost of capital. With Disney, I left the return on capital above the cost of capital. But not at the 12.6% they have right now, but I did push it down. So basically, I'm pushing your return on capital down towards your cost of capital. I gave them a 10% return on capital. You're saying, why do you even need a return on capital? I want to grow 2.75% a year. I'm sorry, 2.5% a year. If I want to grow 2.5% a year forever with a 10% return on capital, that translates into a reinvestment rate of 25%. So starting in year 10, here's what you're going to see me do with Disney. Every year I'm going to take the after-tax operating income and I'm going to put back 25% of the business. If you put back and say, why are you putting back so much? Well, you wanted the growth, right? 2.5%. You want to reinvest less? I'm okay. You want to reinvest 10%? I'll reinvest 10%. But if I reinvest 10% with a return on capital of 10%, my growth rate has to become 1% rather than 2.5%. It's a triangle. My growth, my reinvestment, my risk are all connected. And when I change one, I've got to change the other two as well. So let's say you got your cash flows, your growth rate, your discount rate, your terminal value. You discount them all back to the present. You heave a sigh of relief. Say, I'm done. And sometimes you're done. If you're discounting dividends back at the cost of equity, you're done. What you get as a present value is the value of equity. But if I discount free cash flow to the firm at the cost of capital, you know what I valued? I valued your operating assets. You're saying, what does that mean? I have valued only those assets whose income is part of your operating income. It sounds mysterious. I haven't valued those assets whose income is not counted in operating income. So let's start with Apple. When I take free cash flow to the firm at Apple, discount back at the cost of capital, what's the biggest asset I haven't valued? Cash, $250 billion. This isn't penny change. I have to add the cash. Why? Because the income from cash is not part of my cash flows, and I haven't counted it yet. You know what else I haven't counted? If I'm valuing Yahoo, I take the free cash flow to the firm at Yahoo, if there are any cash flows left. I discount them at a cost of capital. There's a discount rate I can even compute. I come up with the present value. After they've sold their search engine to Verizon, it's probably going to be worth, what, $10? But Yahoo's worth a lot more than $10. Why? What am I missing with that present value? What are the two assets that Yahoo has that I haven't valued yet? Alibaba, the 14% of Alibaba and the 35% of Yahoo Japan. They're both classified as minority holdings, and accountants don't count the income from those holdings as part of operating income. So when I look at the income statement, those are not counted yet. I have to mop up. So I have to add cash. I have to add the cross holdings that this company has. And I subtract out debt, I get a value for the equity. And there's one final piece of mopping up I have to do. The value of equity is the overall value of equity for the company. So when I value Cisco and I come up with a $100 billion value for the equity, you're saying, okay, let me divide by the number of shares. Not so fast. And here's why. Cisco has a history of granting options to its employees as part of their compensation packages. That history is right there in the 10K. It shows you how many options are outstanding on Cisco for their employee options. Those options are a claim on the equity. They're not a claim that's been converted yet, but it's still a forthcoming claim. I have to value the options and subtract them from the value of equity before I divide by the number of shares. So let me summarize. When you discount free cash flow to the firm at the cost of capital, you come up with the value of the operating assets, but you're not done yet. You've got to add cash. You've got to add cross holdings like Yahoo Japan and Alibaba. You've got to subtract debt. Come up with the value of equity. Last step, you look to make sure that this equity belongs to you as a common stockholder. And if it doesn't, you take out that claim and then you divide by the number of shares. You get the value per share. So let me start with the easy valuation. When I do a dividend discount model, I told you all I have to do is discount the dividends back to today and I'm done. So I took Deutsche. Okay? This was in 2008. Remember, I valued them at the dividend discount model. They had net income I projected out. I've assumed that they will continue to pay out the 54% of their net income that they've done historically. That gives me my dividends each year for the next 5 years. I discount the dividends back to today using the cost of equity as my discount rate. What I get as a present value, $9.65 billion, is the present value of my expected dividends for the next 5 years from investing in Deutsche. What happens after 5 years? Well, after 5 years, the company keeps going, right? It doesn't end. So to capture what happens after year 5, I assumed that Deutsche would become a mature company. In fact, the only reason I gave them a 5-year growth period was to see what would happen. At the end of 5 years, I made them a mature company. What does that mean? First thing I did was I assumed if you become a mature company, your cost of equity will look like that of a mature company. And mature companies tend to have betas close to 1. So I gave them a cost of equity of 8.5%. This is another default that's built into your spreadsheet. Is I lower your cost of capital over time towards that of a mature company. And I say, you don't like it? Just override it. Just say yes and override it. But if you don't, I will move your cost of capital to that of a mature company. My growth rate forever after year 5 is going to be 3%, as opposed to the growth rate of 5.4%. I lowered that to 3%. So after year 5, my growth forever is going to be 3%. So here's the last piece. If I'm going to grow at 3%, and I'm going to assume that the return on equity is equal to the cost of equity. Banking is an incredibly competitive business, and I don't see them earning more than the cost of equity. 3 divided by 8.5 gives me my payout ratio. So in steady state, they'll be able to pay out almost 65%. I'm sorry, 3 divided by 8.5 gives me what they have to reinvest. So they'll be able to pay out 65% of their earnings as dividends. So let me step back. For the next 5 years, here's what I see for Deutsche. 54% payout ratio, 5.4% growth, a high return on equity. After year 5, I give them a lower growth rate, I give them a lower return on equity, and a new retention ratio based on that growth and return on equity. But those numbers now are going to help me come up with the value for Deutsche at the end of the 5th year. I take the dividends in year 6. Right? Dividends in year 6 are just the earnings in year 6 times the new payout ratio. You always should be computing that extra year's cash flow when you do the terminal value. And I get a value of 62.318 billion euros as my value for equity at the end of year 5. So if I buy Deutsche, not only do I get the dividends for the next 5 years, but at the end of the 5th year, I sell my equity. That's how much I should get. But it's 5 years out. I discount it back to today. And I discount back the terminal value at today's cost of equity. Not the cost of equity I will have after year 5. And here's the reason. Let's say I'm valuing Snap. The cost of capital I used for Snap was, I think, 10.5%. Why? It's a risky company. 10.5% puts them at the 95th percentile of US companies now. By year 10, I made Snap into a big, profitable, safer company. I gave them a cost of capital of 8%. I computed the terminal value in year 10 with an 8% cost of capital. But to bring that terminal value back to today, because I've got to bring it back 10 years, I used a 10.5% cost of capital, which is the cost of capital today. And my rationale is very simple. To get to year 10, what do I need to do? I need to live through the first 10 years. And during those first 10 years, I'm going to be exposed to all this risk, right? It's a young company, it might not make it. Basically, that's the rationale for discounting back at today's cost of equity. And I get a present value of 40 billion. You add that on to the dividends, the total value of equity that I get for Deutsche is 49.7. Divide by the number of shares. The value per share that I got was 105 euros per share. Stock was actually trading at 89. This one, I dilly-dallied. I said I should buy, I shouldn't buy, I should buy. In fact, I put it off for so long that the crisis happened, so I took it out of my hands. So I can't say I saw the foresight, I saw the crisis coming. I just took too long to act, and thank God for that. Sometimes procrastination will save you a lot of money. Okay? So it's actually not good to invest in a hurry. But it's basically a dividend discount model. Let me close off by showing you Deutsche's valuation today. Don't try to, there's too much stuff in that. I'll send you the link to this. This is actually the valuation I did of Deutsche in October of 2016. And I did this right after the Department of Justice put a $15 billion fine on Deutsche, and the talk was Deutsche might not make it. If the story I'm telling for Deutsche now is more like a horror story, right? Troubled bank, might not make it, big regulatory hole, losing money. So help me out here. If I want to make a troubled bank with a regulatory capital shortfall that's losing money into something of value, we'll go step by step. First, what do I have to do about the losses? I have to make them profits. So to value Deutsche, I assume that their return on equity over time would improve, not to some astronomically high number, but to their cost of equity. I'm not asking for miracles, just make your cost of equity. Over time, the return on equity drifts from a negative number to a positive number. What's that going to do? Your net income is going to go from a negative number to a positive number. They have a regulatory capital shortfall. What does that mean? The Tier 1 capital ratio, in their view, is too low. They need to bring it up. So as you bring your regulatory capital ratio up, what's that going to mean? You'll have to reinvest in regulatory capital. And that regulatory capital reinvestment is what you see as my equivalent reinvestment, 6.51. I talked a little bit about it in the last session. That's what they have to put back to make the regulatory capital ratios improve. This is, believe it or not, an optimistic valuation of Deutsche. Return equity becomes positive, regulatory capital ratio gets filled. Here's the bad news. For this optimistic story to unfold, their cash flows are going to have to be negative for the foreseeable future. What does that mean? They have to issue equity to become a going concern. So if you look at the free cash flow equity, it's negative 11.7 billion, negative cash flow in year 1. That's a huge negative cash flow, and you see it. Eventually, things start to get better, right? Return equity gets better, regulatory capital starts to catch up, my cash flows turn positive. The value that I got for Deutsche per share by discounting those free cash flow equity was about $23 per share. Now I'm being an optimist, assuming all this good stuff's going to happen, right? But it's a money-losing bank with a regulatory capital shortfall. If things get really bad, in fact, if they have 2 more bad years, there is this potential bad outcome. They're not going to go bankrupt. You don't let banks go bankrupt. The social cost is too high. Usually the government will step in and essentially take over the bank. You're saying, why should I care? As an equity investor, your equity will get wiped out, just like GM's equity investors saw their equity wiped out in 2008. Is there a chance that could happen in October of 2016? Absolutely. In fact, I attached about a 10% chance that Deutsche would not make it, which is actually a pretty large percentage for one of the largest banks in the world. And if you don't make it, I assume that your equity was worth nothing. So let's see what we have. A $22.67 value for Deutsche if it makes it as a going concern, and a $0 value if it doesn't. Your expected value across those 2 scenarios was 20.67. Stock was actually trading at $13.33. This time, I didn't dilly-dally too long. In fact, I did buy at that price. This one I've been lucky on because, as you know, Deutsche has issued the equity. It's on its pathway. The pathway back to going concern is going to be rocky, but you can see them moving there. Their most recent stock price was, I think, $18.50, but that's after they gave a rights offering, which I sold in the market because I didn't want more shares in Deutsche than I already had. That rights offering was like $2.50 in cash. But to me, this actually is one of the ways to think about banks as troubled banks, is don't give up. Don't bail out on the bank because things look really bad and you're reading all these bad stories. Take the initiative, try to put a value to the bank, and see what you get with those. So this is not an optimistic story in terms of the returns on equity becoming higher than the cost of equity, but it's enough for me to get a value above the stock price. So on Monday, we will do a review of the numbers you send me. So I need those numbers. Without that, there will be nothing to review, right? And I will close off the last few pages of valuation. I'll embed in so I'll send you a special set of slides for Monday that include the last 10 pages of today's packet, so we can finish that as well. Yep.
I was traveling, so I was unable to get my quiz.
It's still out there.
उसके साथ ही मैं बैठता हूँ, प्रोजेक्ट पे ही काम कर रहा हूँ, तो अभी देख के because first of all they have no tax. I'm doing umbrella. Yeah, no tax because it came in. Yeah. So that is one thing. Zero tax, 5% effective tax rate, and 0%.
What's the margin?
Marginal tax rate because I'm evaluating in US dollars and it is in US listed everything. 40%. That's what I'm using. But for this part, because they have lease and everything, they have some debt because it will be converted. So I cannot reach optimal debt to ratio anyway. It is 0.76, but it's fine, right? Also, the other thing was that when I'm using effective tax rate for this evaluation, I'll use 5%, right? Because that's what. Okay. Thank you.
First of all, the question about Turkish airlines. So I'm using US dollars because it says the contract in US dollars. Like, double check this. For cost of debt, I just want to make sure, besides just taking the credit rating, the rating, just agencies, taking default spread, anything else I have to do.
It's they're rated.
And,
Because the Turkey country is already rated.
Sure. And for the operating basis, there is no year by year breakdown.
They have 1 to 3.